everybody, this is Chris Kirkpatrick back here with you. I am the Safe Bet Money Guy, teaching the secrets of the wealthy to the movers and shakers of the world to avoid the stock market, casino, and gamble-proof their life. Now, this week we're in debt elimination mode, and so here we go. Here's the thing. Most people, I've talked about this a little bit in the course so far, most people think all debt is bad. You have people like Dave Ramsey and Susie Orman out there talking about how debt is just toxic and you need to avoid interest expense at all costs. I'm going to tell you something completely different. And on top of that, I'm not going to just tell you, I'm going to show you how to figure out what debt is good, what debt is bad, and show you a formula that you can implement in your own life to actually impact your financing decisions, impact your purchasing decisions, and how you actually go about A, paying down debt, and B, how you when you go to buy your next car, when you go to buy your next house, when you go to do whatever you're going to do with your money, how do you decide whether you should pay cash or whether you should finance? And most of the time, I'll tell you, paying cash is going to work out the best, but that's not the case in all situations, and it'll all make sense, a lot more sense, in just a moment. So ultimately, what I want to do is I want to teach you how to calculate your cash flow score. And the cash flow score is just something, it's a formula that we came up with that really will help guide you where you want to go. And what that is, you take whatever loan balance is, and this, by the way, will help you pay down your debt in the most effective, efficient way possible. It'll help accelerate you getting to where you want to go financially. And you take your debt that you owe, whatever the loan balance is, and you divide that number simply by the minimum monthly payment that you owe on that, because that's your cash. And a lot of people think they're emotional about this. They get emotional about debt, and the last thing you want to do is make emotional decisions when it comes to your money. And so a lot of people will say, you know what, there's different types of loans. They look at different types of loans in different ways. They can say, oh, I got a $10,000 loan, and there's a $500 payment with it, and maybe that's a car loan, maybe that's a small business loan or a personal loan or something of that nature. Or they could say, I got a $100,000 loan, and because that $100,000 loan is either a line of credit, it's either a home equity line of credit or a mortgage, a second mortgage, or something of that nature, that payment would be $500. So obviously, the payment that's $500 for the $10,000 loan is less efficient than the payment that's $500 for the $100,000 loan. And that will create a cash flow score. And what you want to do is the lower the cash flow score number you have, the faster you want to pay that off. In fact, I'm going to tell you right now, if you can ever find a cash flow score number, and I'm going to go through this in a second, but if you can ever find a cash flow score number that's above 150, especially above 150, you want to roll with that. That's most of the time something that you're going to want to finance, because typically speaking, you can earn more, you can position yourself better and leverage your money more effectively, putting it in a safe account, earning a guaranteed interest rate higher and higher and higher. And that's going to help create wealth incrementally, systematically over your life, over your working career. And it's going to give you more leverage and open more opportunity for you. And so what I want you to do is I want you to think about your life as a business. I want you to think about your finances, your personal financial situation, the way a business owner would think about their business's financial health. And what I mean by that is I'm saying I don't want you to have debt. And I don't want you to misconstrue what I'm saying here, because having debt is bad for sure. But what I'm saying is that you can have some debt that you can leverage to wealth creation. And here's why. If you put yourself in a position where you have some money that you have debt on and it's tax deductible and you're paying less interest in one bucket than you're actually earning in another bucket, we call that arbitrage. The spread between those two numbers is arbitrage. That means you're making money on the money that you've invested simply because you financed it and you have that extra money. You're saving that extra money. The key here is you want to operate inside of a system, right? Like we've talked about. You don't want to ever put yourself in a situation where you go and finance something, and instead of saving the spread or saving the money, you're going out and you're spending it on lifestyle, because that's going to just create a snowball of debt, which is going to obviously be very, very, very toxic. But ultimately, if you think about your finances, your personal financial life, the way a business owner thinks about their financial life, their business's financial health, the ultimate goal is to have more assets than liabilities. And what I'm saying to you is if you have a mortgage, right? I'm not saying I don't want you to have your house paid off. I'm saying the ultimate goal is to get to a place where you can have enough money in an account that's earning more than you're paying in interest on your mortgage, if that makes sense, and have enough money in that account so you could stroke a check. You could write that check and boom, the house is paid off. Because if you have $250,000 in an account earmarked for your house, right? Because it's ultimately what you want, but you have a $250,000 mortgage, but your mortgage is 4% and you get to deduct that. Let's say you're in a 25% tax bracket. That means your net cost to borrow for that house is 3%. So if you could be earning more than 3% on the $250,000 in this side account, that's arbitrage, that's spread. And if you could earn 1% per year spread on a $250,000 over a period of time, that adds up to a lot of money and you have to take no risk to get there. So before I get into describing and walking through some examples of the cash flow score, I want to talk about like what affects your cash flow score. What is it? What factors come into play when you're going to buy a mortgage, when you're going to finance a car, when you're going to make any decision about borrowing money and making purchasing decisions? So the first factor obviously is the loan amount. The higher the loan amount, the more you're going to be paying most likely over the long run. Now, obviously there's more that comes into play than just the loan amount, right? You have the interest rate. The interest rate is obviously gonna have a massive impact on your auto loan as well. Like let's just use a car for example. If you go out and you get a $30,000 car, well, the $30,000 car is the $30,000 car, but you could go out and if you have bad credit, you're going to have a 8% or 9 or 10% loan right now. If you have good credit, you could get that as far down as 2 or 3% at this point in time, especially for new cars. You can even get financing at 0.99% at this day and age. So that is something to think about. Your interest rate is going to play a factor, and your credit score, your current financial standing, your debt to income ratio, all that stuff is going to come into play as to what interest rate you get. Now, on top of that, the biggest factor that will come into that, and this is one of the things that gives mortgages so much leverage for people, is that the biggest factor that people don't realize that impacts your cash flow score is the duration of the loan. And I'm going to show you why in just a little bit here. But the duration of the loan is actually going to have a huge impact on your credit score. And then on top of that, you have other things like different lines of credit. You have revolving credit like credit cards, store charge cards, stuff like that. And your minimum payment is also going to have an impact on your cash flow score, because a lot of people they want to just pay down debt. They just want to try to get rid of the highest interest rate debt first. But I'm going to tell you right now that that's not necessarily the best, most effective thing for you to do. In fact, not the most effective way for you to pay off your debt. So here's the thing. Banks, though, on the contrary, have done a great job at convincing people that shorter loans are better, that you want to just try to pay off your debt as quickly as possible. And what happens there is that actually that mindset can hurt you if you don't navigate it properly. Because when you take a shorter loan duration, what happens is, and they incentivize you to do that, when you take a shorter loan duration, they'll give you lower interest rates. They're doing this on purpose. And when they do that, what happens is it ups your debt to income ratio, because when you shorten your loan duration, you actually increase your monthly obligation to make that payment. And so what happens is it reduces your credit score, because your loan debt to income ratio goes higher, right? Your debt to income ratio goes up, which lowers your credit score, which then makes it so you pay higher interest rates on debt in the future. And in turn, what that does is it reduces your security. It makes it so you're more vulnerable during economic times of crisis. And it will make it so you don't have access to leverage. You don't have access to credit when you need it the most, when times are tough. Listen, when times get tough, lending tightens up. And if you don't have an impeccable credit score, if you don't have yourself in a position where you can really leverage your financial standing, you're going to be in trouble. Now, what I want to do is I want to show you a way to take this, leverage it, increase your credit score, increase your financial position, and make sure you have enough money saved in a bank so you can take advantage of as much opportunity to create wealth as possible. So this all plays into the same system. So let's get in right now. I want to get into some examples. Let's get into, I have like 4 examples that I kind of want to walk you through. And I want to go through and just to kind of give you an idea of what it all looks like. So the first loan that I want to talk about is a mortgage. Now, let's use this example. You got a $250,000 mortgage, 5% interest rate. What you have there with principal and interest, I'm not going to take taxes and insurance into account because that varies from place to place, but you got a $250,000 mortgage, 5% interest. What you're going to have there for a 30-year mortgage is a $1,342 a month payment, $1,342 a month. What does that do? That creates a cash flow score for you for 186. Your cash flow score is 186. And so I'll tell you right now, if you can get a cash flow score, the higher the better, over 150, you're styling. I would take that. It's money in the bank. Run with it. It's leverage. And I'll explain why after. Now, the second loan is an auto loan, is a car loan. And so the car loan, just for an example, you have a $30,000 car loan at 5%, financed for 5 years, which creates a car payment of $566 a month. Now, first of all, $30,000, most people out there probably shouldn't be driving a $30,000 car if they can't afford it, if their income's not high enough. That's another topic. But $566 a month, that creates a cash flow score of 53. And so 53, anytime you're in the 50 range, that's kind of getting towards toxic level. Anything to me below 50 is going to be toxic, and we want to get rid of that loan as fast as possible because it's going to hurt your cash flow, it's going to reduce your credit score, it's going to hurt your financial security, it's going to put you in a position of vulnerability, which is the absolute last thing that you want to be in. Now, to take this to the next level, what I want to do is say, okay, so that was the example for the auto loan, is that you had the $30,000 5-year 5%, and what you had was a $566 a month car payment, which created a cash flow score of 53. What a lot of times people say, well, never finance a depreciating asset. Well, I'm going to tell you right now, you probably shouldn't be in that car in the first place if you're worried about this, or if you haven't structured your whole financial life properly. And we'll teach you how to do that, right? But the bottom line is that most people will try to say, I'm going to try to pay it off faster. Well, if you do that, you take the $30,000 car loan, 5%, you put it over 4 years, and what happens is you run into a car payment of $691. Now, a car payment of $691, same car, same value, same everything, but the challenge is now your cash flow score is 43. So when you compare a 5-year loan for a car versus the 4-year loan for the same car, same parameters, same everything, you can see that by reducing the duration of the loan, it actually increases or reduces, I should say, your cash flow score, making it more toxic, making it more dangerous, more vulnerable. It hurts your credit score, hurts your financial security, and puts you in a situation of financial position where you actually are more vulnerable to economic swings. And when that happens, you're less likely, less able to take advantage of opportunity in the world as it presents itself to you. So now I'm going to get into credit cards because a lot of people have credit cards. The average credit card debt in this country for families that have them is over $15,000. So I wanted to use a credit card balance of $15,000. And what I did is I used an interest rate of 12%. And what happens there is if you kick that out, for most credit cards, every credit card has a different formula, but you just need to make sure that you take your statement and you do the math on your own statement. But every credit card has its own formula, and for $15,000 at 12%, based on the formula that I have for the credit cards that I use, you're looking at a $220 a month minimum payment. Now, most people would say, well, that's 12% interest compared to the auto loan, which is 5%. You want to pay that down as fast as possible. Well, I'm going to tell you right now that debt from a cash flow perspective is not as bad. Now, I'm not saying you don't need to pay that off, because you definitely do. The interest rate is toxic, but I'm saying from a right now perspective, if you have debt, if you have auto loans, if you have credit card debt, if you have all sorts of different lines of credit, how do you go about navigating it in the best way possible? You want to start gaining momentum. You want to start recapturing that cash flow as quickly as possible. The best way to do it is to pay off the auto loan, pay off the low cash flow score, because those are the most toxic, first. And then once you have that money, you can reposition that money and put it all right into the credit card, put it in and really accelerate that debt pay down at that point in time. And just to recap, I have a $15,000 balance on the credit card for this example at 12% minimum payment of $220. That creates a cash flow score of 68. And you can see 68 is higher than 53 or 43. So we would pay that off after either one of those car examples. Now, obviously, the mortgage in this situation is the highest number, and so we roll with that. That's just going to be good. We're gonna let that loan go as long as possible, especially when you add in all the tax benefits, the deductions, everything. That is an asset that you can leverage and you can actually position to create wealth for yourself. So taking this to the level, I want to throw in a little bonus here for you. I want to get you thinking. Is that here's the bottom line. A lot of people will say, you know what, never finance a depreciating asset. And I'm going to say BS. I'm going to call BS on those people, because here's why. Is that if you can earn on a guaranteed basis the same interest rate that you're paying on the loan, right? So I'm talking get your credit score up so you can get cheap loans. If you can earn on a guaranteed basis the same or higher than you're paying on a loan, you need to take that loan every single time. And you need to keep your money in the bank, because I can't tell you how many times I've talked to people that say, you know, I'm going to go and I'm going to buy my car cash, right? Because if you're in a situation, if you're in a position where you can afford to pay cash for a car, for a $30,000 car, you're doing okay. And most people are cash buyers. Most people are savers. They want to go out, they want to buy their car, they want to avoid the expense of the interest. Most people think, I'm going to pay cash because I want to avoid that interest. And they do that thinking, you know what, if I go out and I have a $30,000 car and I finance that car over 5 years, my interest expense on that car is going to be $3,162. And so they do this hoping to avoid the $3,162 interest expense. And they think they're getting ahead by paying cash. But the reality is they didn't think about the concept of opportunity cost. And we've talked about that. And so what I'm going to tell you right now is if you had that $30,000 and you could put that into a system, into a position where you could earn 5% on a guaranteed basis, right? The same amount that you're paying. And this is just a principle, talking about the principles of how money works. Every situation is going to be completely different. You just have to know how to make your decisions. So if you could put your money in an account that earns the same as that 5%, well, what does it look like? Well, you A, kept control of that money so you didn't tie it up in the asset, and B, you wound up earning $6,627 in interest. So if you, rather than pay for the car, yeah, you incurred a $3,000 interest expense by financing the car, but at the same time, if you kept your money in an account, you earned over $6,000 in interest. And at the end of the day, the net gain that you have by doing exactly what I just said is $3,465, all based on the way that you financed a car over a 5-year period. Now, I know $3,465 isn't a ton of money over a 5-year period, but I don't know anybody in the world that if every 5 years they got a $3,465 check, I don't know anybody in the world who wouldn't like that, who wouldn't want it. And so really, really important stuff, guys, is to understand your cash flow score, understand how that impacts your ability or your decision-making process when it comes to financing cars, making purchases, and anything in your financial life, especially when it comes down to paying down your debt. And so as you're filling out the debt fountain worksheet, I want you to really integrate the cash flow score into thinking about that. So guys, I hope that helps. If you have any questions, feel free, post them in the comments below. I will engage. I will answer any questions that I can. And until next time, live abundantly, live efficiently, live life 180.